Good morning, Southern California. I'm John Baldwin with John Hart Real Estate, and today is September 19th, 2022. The Fed meeting is going to wrap up, in 2 days on the 21st. And we're anticipating another 75 basis point rate hike on the Fed funds rate or the prime rate. So I wanted to get into it. Was not feeling well last week. Sorry about that, guys. Meant to get a video out, just didn't. But I want to touch on the article I was going to touch on last week and then roll that into what we're talking about for this week. And we can get that together. But yeah, last week I jacked my shoulder up and was just in immense amounts of pain. And just it would not have been a good video to put out with me cringing. So just wanted to make sure that I'm not wincing while doing a video. So let's get into this and I'm going to see what we can do here. So, all right. So CNBC.com article, mortgage demand. This is the one I was going to touch on last week. From home buyers fell 29% since last year. Yes, we are definitely seeing a buyer pullback right now. Buyers are very rate sensitive. They are looking at what's going on with interest rates and going, hey, my cost for money has gone way up. I'm going to kind of do a little bit of a wait and see and just kind of watch how things settle out because, you know, as agents, we get people who they have a recency bias. Their only understanding of a shift in the market is the last market cycle, which was the '08 crash. We are fundamentally in a very different place than we were in '08. So we don't have the subprime mortgages. We have people with piles of equity right now. I mean, especially over the last couple of years, equity, I mean, people have just shot up through the roof and we have a lot of people sitting on like 40 or 50% of equity on their house. So this is a great opportunity for people sitting on equity to cash out. But what we're seeing is we're not seeing inventories climb like we anticipated. So listings are trailing where we thought they would be. Now, when you have buyer demand fall off and listings fall off, it actually creates a weird stasis where we're kind of going sideways right now. I've also pulled the InfoSparks data. The InfoSparks is from my board of realtors. It's the MLS data. They pull CoreLogic data. And I've got a slide I want to get into and kind of show you what we're looking at as far as Burbank, Claremont, entire MLS, and then also LA County. Because I want to taking a city right nearby, a city at the other end of the county, the whole county as a whole, and then also the MLS system and see what's going on there as far as months of inventory. Now, you've heard me talk about months of inventory as the magic metric. This is, you know, the absorption rate. How many months of inventory do we have on the market right now, and how quickly will they be absorbed? And we are stuck right around 3 months of inventory right now as sellers wait to put their properties on the market to see what happens, and buyers wait to pull the trigger on an offer because they want to see what happens. We have a lot of people waiting and seeing. There's a joke going around Realtor Instagram about, you know, I'm patiently waiting for my buyers who are patiently waiting for the market to crash because, again, we're in a fundamentally different boat. We do not have toxic subprime mortgages. We don't have all these crazy, weird negative AM loans and stuff like that. But we are seeing lenders get creative. They're still qualifying people on the full interest rate, but we have some programs being rolled out where you can, for the first year, you're paying 2% below the market rate. And then for the second year, you're paying 1% below the market rate. And in the third year, you're paying the full market rate. Now, this is very different than the old negative AM loans or the teaser rate loans, where they would, the teaser rate loans, frequently they would only qualify you on the teaser rate, not the full rate. This is all the new stuff is you're being qualified on the full rate. And then there's an impound account with the lender that they are contributing to part of this rate buy down situation. So there are a lot of details I don't have, but give me a call, 213-973-3777. I can hook you up with one of my lenders who is doing one of these great, you know, reduced rate programs for the first 2 years. I even heard of somebody thinking about doing a 3-year program, but I haven't seen that yet. So, but let's get deeper into this article. Application volume dropped again. Since last year, home buyers' demand for mortgages has fallen by nearly a third. Yes, we are seeing buyers pull back as prices are up, interest rates are up, so their cost of their loan every month is a lot higher than when you had a 2.5, 3.5% interest rate. So, and then the refi boom is over. Like, there are very few. I think further down in one of these articles from today, they're going to say there are less than 500,000 people who would benefit from a refinance at these higher rates, because most people have refinanced over the last couple years at these really, really low rates. So, why would you be, refining at a 6% if you've already got a 3.5%? So that's what they're talking about here. So, all right. Mortgage demand appears to have nowhere to go but down as interest rates go up. Yes, people have to get, kind of get reacquainted with what normal interest rates are. We had an artificially low interest rate environment for 2.5 years as the Fed tried to navigate the COVID debacle. So, let's get into this a little bit more. The average contract interest rate for a 30-year fixed rate mortgage with conforming loan balances 647,200 or less increased to 6.01 from 5.94, and you pay it a little bit lower origination too. The 30-year fixed mortgage rate hit 6% mark for the first time since 2008, rising to 6.01, which is essentially double what it was a year ago. This is why there's a buyer pullback. This is why there's a refi pullback, because rates have just exploded. And here's where I was talking about. With rates above 6%, only about 452,000 borrowers could benefit from a refinance, according to Black Knight. So this is one of those. We have a lot of people, like the mortgage refi boom is over. What can I say there? So, yes, we're seeing a rise in adjustable rate mortgages and jumbos. What else? It was the last shoe to drop before the Fed announcement. Now as I said, we are anticipating another 75 basis point rate hike on Wednesday. Now, lenders have already factored in this for the most part, but I think you're going to see a little bit of a spike following the meeting on Wednesday. Because they're going to be pointing to, more inflation, especially with inflation not coming down like they thought they could get it to come down. They're trying to thread the needle and get a soft landing and a shallow recession. And they are, really trying to thread that needle to get us through this. So, all right, on to this next article. This is from today. Another interest rate hike is coming from the Federal Reserve. Here's how it could affect you. They're anticipating the 75 basis point rate hike. Yes, it's going to impact credit cards, car loans, mortgages minimally, student debt, and savings. So, all right. Fed officials have declared inflation as public enemy number one. Okay. I'm of the opinion that the Fed is behind the ball on this, that if they started raising rates a year earlier, that they wouldn't be having to do these drastic and bigger rate hikes right now in order to try to tamp it down. So I think they thought they could slow roll it, and unfortunately they got caught, and now they're having to play catch up. So let's see, what else can we get into here? Fed funds rate, All right, so credit cards. Your prime rate on your credit card is going to go up. So when they raise it 75 basis points, your credit card interest rate is going to be higher. Your auto loan interest rate is going to be higher. But your mortgage, and this is why I pulled up this article, because your adjustable rate mortgage and your home equity line as a credit are tied to the prime rate. But 15 and 30-year fixed rate mortgages are tied to the 10-year treasury and the overall economy. So there's not as much of a direct relationship between the Fed overnight lending rate, the 75 basis point rate hike, and your mortgage. But the lenders, they get their money, they have to pay that overnight lending rate. So it does get factored into the rate that they give you. but it's not a direct like one for one. Like if the Fed raises rates 75 basis points, your interest rate's going to go up 75 basis points. That's not the case. They're not as closely linked as that. So just an FYI on that. And and then here they are. They're reiterating that nearly a third, a decline of demand for mortgages of nearly a third. And this is definitely what we're seeing is a buyer pullback as their cost of money has gone through the roof. Now think about it. Your interest rate at 3.5%. Now it's at 6%. Your payments are going to be about 40% higher than it was a year ago just because. So this is where, the cost of money can impact housing. And, we used to be able to throw extra money at a listing to get it because that cost of money was so low. But now with the cost of money being a little higher, buyers are more reluctant to throw extra money at things, which is causing sellers to have to negotiate, which I like to negotiate. I like knocking prices down. That's why I love working on the buy side when I'm working with buyers, because it's the fun of negotiation. So, yep, your auto loans are going to be a little bit more expensive, even though it's a fixed rate. It's just because auto loans are tied to the prime rate more directly. So, student loans, I believe those are also tied to the prime rate. Congress sets the rate for federal student loans each May for the upcoming academic year based on the 10-year Treasury rate. Oh, I did not know that. Okay. So I guess student loans are not as directly tied to the prime rate as I thought they were. I thought that they were done. Private loans may have a fixed rate or a variable rate tied to LIBOR, prime, or Treasury bill rates. Okay. Yeah, it depends on which benchmark they're tied to. If they're tied to prime or to LIBOR or to Treasury, Treasury is going to be a little more stable. Prime is what is more directly tied to the Fed funds rate. That's what they're changing is the prime rate. So, all right. And savings accounts. Let's see what they got here. So, all right. Interest rates on savings accounts. So your savings are going to be a little bit better. Not that we get a good rate on our savings in America. I mean, we're lucky if we get, a few pennies. So, yeah, we're going to be up a little bit on your savings account. But let's jump into the InfoSparks data here. So, okay. Oh, that doesn't show up super well. Let me see if I can get it here. Okay, yeah. All right. So, here we are, and this is 2018. Entire MLS in September of 2018 was at 5.1 months of inventory. But where are we today? So this is the end of August, so this is a couple weeks old. And as you can see, 2 months of inventory in Burbank, 2.3 in the entire MLS. Claremont's up to 2.6 months, and LA County 2.5 months. But you can see this trend line is starting to curl over a bit. And this is where we were anticipating being higher already. We're a good 15, 16% lower in the listings we were anticipating than what's actually coming. So this is where there's a bit of an opportunity for a seller who does need to move, because you're not going to have as much competition as you thought you were. And for the buyer, you're also not going to have as much competition as you did a year ago or even just 6 months ago, because there are fewer people competing with you in your price range than there were just a few months ago. So these are all good data points to pull in. Entire MLS has actually dropped. See this top one here? I believe that's the blue line. And you can see it dropped to this 2.3 mark, down half a month. Now, I also did another one that was LA City, and it had a strange spike in it right here, September 2020, which is basically there was a flood. As soon as COVID lockdowns opened up, there was a flood of listings that hit the market. And then you can see they just got all snapped up here. And so that's LA City. And LA City is now sitting at 3.2 months of inventory at the end of August. So this is all great data to have. But what it's pointing to, what I'm seeing here is we're not getting the inventory coming online that we thought we were. Buyer demand, buyers have pulled back, so we need to make sure we price your house accurately. The key to this market is accuracy and knowing what your comps are and saying we are in line with our comps. We just don't want to be going on a fishing expedition where we list it high and then we have to come back down, because anytime you list high in this market, you're going to be selling low. And if you list low in this market, like a year ago, we loved to list on the low side because we knew we were going to get enough eyeballs on it to drive traffic and launch that price. But right now, we don't have the traffic to drive the price up, so we need to be accurate, because if you price it low, people are going to go, okay, I'll go with that price and run with it. So you need to be accurate. You need to be in line with your comps and know your data. So this is where we are right now, where accuracy is, again, the name of the game. Where a year ago we could prime the pump, be low, and then launch it. You're not going to do that right now. Not unless you have an absolutely spectacular property that is priced perfectly and then everybody wants it. There are still overbids happening, don't get me wrong, but the property has to be perfect in a prime location. If your house is not a 10 out of 10, you're not going to be getting those overbids right now. So definitely something to take into mind when you're getting ready to list. But there's a lot going on right now. The data is pointing to basically we're kind of going to go sideways for a little while as far as values, because I'm not seeing the inventory come online like I would expect if we were going to have a ton of downward pressure on prices. Remember, in 2008, when we had the big crash, we had almost 18 months of inventory sitting in the MLS. So right now, hovering at that 3 months of inventory range, even with buyer pullback, I'm not seeing any major downward pressure on prices. There is going to be some fluctuation. And then we're also in the part of the cycle, what I call it like the separating out, where the cream of the crop is going to rise to the top and the dogs are going to move all the way to the bottom. You're going to start having prices separate out again. And so this is a normal part of the cycle, and the separating out of basically, if you have a 2,000 square foot house and one is absolutely luxurious and gorgeous and in the perfect location and one is a fixer, they're going to separate out so you get those price differences again. Unlike the last few years where you could put anything up in a decent location and just get absolute top dollar because our inventory was so low that demand just, pushed everything through the roof. So hope this helps. Let me know if you have any questions. Give me a call, 213-973-3777, and let's get your house sold.